Hi guys, I thought I'll make a video. It's going to be much more simpler for me to explain the synergy between the charts and the fundamentals that I'm looking at. So as you know, inflation is up by 7%. That is what the Federal Reserve is saying. But I've been doing my calculations over the weekend, and I believe that inflation is not at 7%, but actually double of that, around 15%, okay, and could be possibly 16%. Um, Federal Reserve needs to actually step in and curb inflation, what it's supposed to do with monetary policy. That means they need to increase interest rates. They need to come up, and now with more data that has been released, I believe that to boost even consumer confidence, Federal Reserve needs to put a price ceiling of products and services. That means, just like in the UK, if you see the energy prices are going up, but the governments have stepped in and said that a certain price level, the suppliers cannot charge more than a certain rate. Um, that has led to a lot of businesses closing down, but the economics of scales normally work in this way that supply is met when the demand is there. So if one business shuts down, the others open. It's going to be the same thing in the United States. Federal Reserve has to come in, either support the businesses by paying them the difference of the prices. Normal products and services need to actually have a lower price for the general public. So having said that, when do you expect the interest rates to rise? Is sometime in March. So from now as in January 18th until mid of March, we have roughly around 2 months. In 2 months time period, we have about 48 trading days. In that time period, what I'm looking at is a consolidation that's beginning right there. Well, let me just draw it with a trend line. Okay. So what I'm looking for is consolidation down. Okay. And then up. Okay. And then down. All right. So forth and so forth. So if that's what I call a compression area, a consolidation area, and you're trading towards the end, where the probability of the indices falling has increased considerably, and that should lead to a dollar long position if the indices are falling. And that says all of it, but let me also see the dollar index chart. It's right here. It's also consolidating now, and this consolidation could go up and then down and up and down and then shoot up again. So that's what I'm looking at, and the charts that you see on the screen are weekly time frames and larger time frames. So when I said on the daily focus that the markets are moving sideways, generally they are going to favor markets, in the sense as in indices are going to favor long positions and dollar short positions, and then we're going to see dollar long positions coming in closer to the interest rates rise or any decisions by the Federal Reserve that point out to curbing inflation, reducing balance sheets, and let's say even putting a price ceiling on products. It's going to show a dip in the market. It might not be as severe as it was back into, when the pandemic started and this was the recession hit. But it's going to be there. So the best way to trade it is trade on a smaller time frame. Go in and out of the markets. Understand that you are probably at the peak of a cycle. We will see a downtrend, but if the Federal Reserve plays it very subtly, we will not see a greater dip. We will not see something that will cross 20%. We'll probably see something at 10%. But I'll keep you guys informed. But that's all I wanted to get through. So this is the chart for US 500. That's the Dow Jones. So if you see that, that's the consolidation that's going to happen. Well, it already begun, so that's the consolidation. right there, and also the Nasdaq. Yeah. So the direction is still to the upside. Okay, I haven't changed my direction yet, but it is getting there. Hope that clears up things.